Hey everybody, this is Jose Blasco. How are you, my friends? We're about to get started in around 1 minute time. Let's use this time for sound check as we always do. Please type a quick message on the chat box. A quick hello would do, so I know you hear me. Always good, always nice to say hi to everyone. Plus now I know sound is good. Please go ahead and do that. So we start in 45 seconds. Thank you so much. Almost there. 30 seconds to go, and we'll get started with the session in just a moment. Okay, this is appreciated, my friends. Very good. 2, 1, 0. Here we go. We just hit the top of the hour, so it's time to begin our session. Welcome, everybody. This is February 27, 2022. My name is Jose Blasco. This is a top session. Before we get started, quick highlight of the disclaimer on the upper left side of the screen. Please read it carefully. This is important information, as you know. It's fairly short. I was pointed at it, and therefore I'm counting on you to read it completely, as it is important information, as I just said. Now that this is out of the way, we can talk about the agenda for the session, which is basically it's all about top. And of course, in order to learn how to use the platform properly, often we need to mix a lecture when it comes to the use of the software together with trading, because sometimes we cannot talk about the software unless we clarify certain concepts related to trading as well. So it's all related. Therefore, we have platform time, we'll have lecture time, a bit of a mix, and of course, ready to get your questions, ready to provide you with answers. So please feel free to be interactive as you are in the sessions. So please, in those sessions that we do over the weekend, where we have plenty of time to address things because the markets are closed, I would like to ask for extra engagement, so you take full advantage of the session. Good to see you, Jeff. How are you, my friend? Good to see you, everybody. So let's begin. And quick highlight as we begin the session as well. I wanted to highlight the page tradewithufo.com/Jose. This is the page where you can interact with our support team in the form of questions and answers. So it is very useful when you have anything to consult. You come in here, type your question, and find the answers. If the answer is not there, then you can click on the purple button, log in, then click on the green button, type your question. The question will now be part of the list, and then our support team, as well as the rest of the traders in the community, can go ahead and interact and provide answers and have very nice conversations that lead to everyone's growth. So any question, feel free to use the question page. Now you know the link. You probably knew already, but if you're new to the sessions, that's how you do it. Very good. So here is top, and let's begin our session for today. Okay, so today I am glad to say that we spent a bunch of sessions. I'm just opening a full screen chart here. We spent a bunch of sessions going over studies. Okay, and I'm glad to say that today, in today's session, we are going to be finalizing the list, meaning that after today, all the studies available in the platform will have been addressed, will have been reviewed, will have been explained, and therefore you will know how to use them. How are you, Mark? It's good to see you. Good to see everyone. So let's do that. This is the objective for today, to complete the list of studies. That way, in the following sessions, we'll now start being able to work on other tools, such as the matrix, the option chain, the spread builder, etc., etc., etc. Also, I know that there are certain tools that may be more or less urgent to some of you. So feel free to share with me in the chat box during the session today. What is it that is most important to you in the following sessions? Christian, you seem to have no sound. Could you guys please confirm that sound is okay for everybody? Because Christian seems to have no sound. I'd like to confirm that. Just in case the issue is on my end. I don't think so, but just in case, please confirm that on the chat box when you have a moment. So again, as I was saying, today I'm going to complete the list of studies. Sound is good there, Ahmed. Good. Thanks for sharing. So Christian, let me type this on the chat box since Christian cannot hear me. One moment, guys. Okay, so I just send a message there so Christian can read it as well. Okay. Anyway, so as I was saying, I'm gonna complete one last time. I'm gonna complete the list of studies today. For in the following sessions, I'm gonna start with other tools, and I would indeed like to know more about what's most important to you. I know we receive constantly messages from you guys and so on. So my initial intention would be that the next tools to be addressed would be the matrix. But again, if you have other urgencies, I'd love you guys to share that with me today in the chat so I can prepare in a way that is compatible with your needs for the following top session. Okay. Cool. Okay, so let's while you type, I'll begin with the list of studies. Okay, and to be honest, we went through this list almost perfectly from up to down, even though we made a few exceptions because some of those studies were related to each other, and in some of the lectures, for example, when we talked about RSI, we also talked about commodity channel index, things like that. So we didn't follow the list from top to bottom perfectly. We had some exceptions, okay? But today I will go from up to down, and find the missing components, such as choppiness, which is one of the studies that we never got to address. So I'm going to talk about that right now. So first of all, let me add choppiness. I'm just going to use standard values. Click OK. Looks like that. And now let's talk about it, and let's talk about how to use it and all of those various things. Okay, Mark, the matrix steps for the different climate conditions is what I want to get the rules. Got you. Perfect. Okay, so then we'll be talking about the matrix. That will be the next tool that we'll start exploring together. Starting next week. Okay, the matrix, to be honest, allows to do so many things. It's really impressive when it comes to the various different possibilities, different trading styles that you could implement using the matrix. Okay, so we will indeed talk about this and talk about preferences for rules, for steps, and so on. But anyway, today we are talking about choppiness. Okay, and when it comes to choppiness, so the first thing I wanted you to notice when you insert that tool, apart from the fact that there is a setting by default, like most technical indicators, is 14. And that choppiness tool basically provides you with a measurement, a line that goes up and down, and it goes up and down either above or below those two horizontal lines. By the way, I'm drawing the horizontal lines behind the video stream. Okay, so here are the horizontal lines I was referring to. Okay, and those lines go above and below. So I need to explain the meaning of those lines, and I need to explain the meaning, most importantly, of the blue line, which is the choppiness calculation itself. So choppiness basically is a measurement that determines if a market is trending or not. A choppy market is when the market goes up, down, up, down. There is no clear decision on price movement and direction. Therefore, there is no reliable trend to be traded. And when that's the case, if you are a directional trader, you may want to pass. If you are a non-directional trader, you may be very happy that there is no clear indication for direction. This is what choppiness is basically calculating, okay? Now, the way you read choppiness is actually backwards compared to the majority of other indicators. And that's one of the reasons why I left it for the end, because the higher it goes, the more choppy the market is, right? You may think if it goes up, it's kind of like strength coming in, and therefore the market is moving higher. Well, no, it's the opposite. The higher the number, okay, the higher the number, the more choppy the market is. For example, at this particular case, we have a peak of choppiness. So if you were to look at what was happening at the market in that market at that time, you can see how there was no clear decision or direction when it comes to price moving. The opposite is true. When the choppiness values are very, very low, okay, we are dealing with very strong impulsive moves. In this example, to the downside. It could also be to the upside because choppiness does not care about direction. For example, in this case, the value of choppiness is very low, and when you look up, you are looking at a very strong move to the upside. Okay, so in other words, when the values are low, it means the market is impulsing. When the values are high, it means that it's either a corrective move or there is no decision, and definitely there is no impulse. The market is choppy. Okay, so remember, it's kind of backwards to what you may think out of common sense, especially if you are used to other indicators or studies. In this case, the higher the value, the less strong the movement. Okay, the more choppy, the choppier the market is. So with that in mind, now that we know more about choppiness, and of course you can change the settings, right? So you can change the settings for length. So you may look at, a smaller value if you want to have more signals, a lesser value if you want to have less signals. You can also define the upper and the lower band as different numbers. Okay, by default they come as 38.2 and 61.8. You could certainly use other calculations depending on your backtest and your preferences and how extreme you want to be. For example, with the settings 61.8 and 38.2, every time or almost every time you get a case of choppiness, normally it doesn't last too long, right? So for example, right here, you have a case of choppiness. Okay? It had to do with this, and after that, it's not choppy anymore, right? So here you have a case of choppiness, right? So the market was not doing much, okay? And next thing you know, now it's impulsive, no choppy anymore, right? So with those settings, typically your identification of choppiness are not very long lasting. And in that sense, these type of settings could be useful. Again, all of this is to be backtested and depending on your preferences, but this kind of setting could be useful for traders looking for contractions in the marketplace. What is also commonly known, or you can hear that term in the industry as a squeeze, a market squeeze. So when the market is contracting or squeezing, expecting an expansion, okay, or a strong move away after that period of consolidation, contraction slash squeeze. So a trader, you may be looking at this, okay, you're waiting for this, right? You can obviously see with price action the market was consolidating, but instead of looking at data which could be observed in a subjective manner, which is the problem of candlesticks, so you are now looking at a measurement, which is a mathematical calculation. You are above the upper horizontal line. That means the market is technically choppy based on your indicator. So you may work for a crossover for when the market now crosses below the horizontal line, meaning it's going from choppy to not choppy anymore. Okay, and this would be happening on this candle. So now, starting from here, you see the movement is to the upside, so you would understand a new trend or a resuming. The trend is resuming to the upside, and now you will want to start trading to the upside. In this case, it didn't go that much far away, but again, you benefited from a period where the market was going from less volatile to more volatile. Look at the size of those candles. No matter how far it went, look at the size of those candles compared to the size of the prior candles. Well, we had that effect of the market was squeezing and then expanding out of such squeeze or contraction. You can do that again in any instance, really. So, for example, at this stage, we have an indication for squeeze. So you do nothing until you got the crossover, right? So the crossover is happening at this moment in time, right? So the market was squeezed, right? And now volatility is supposed to come in, starting on this candle. So, you could plan a trade and hopefully you catch that move. Again, that's the concept that could be exploited if you were to use choppiness with this particular type of settings. Okay, I want to show you another application of choppiness in a moment. Joe, I never seen this. Is this a DT indicator? Is it another platform? No, this is a classical technical indicator available in many platforms. Not in all of them. It's not as typical as, let's say, RSI or moving averages, but it is relatively well known. If you were to Google choppiness, you would find the mathematics behind the indicator and how it's calculated. Okay. Now, the Other application I wanted to show you is maybe use a condition which is lower for the upper band, for example, 50%. Okay, and in that sense, now every time the market goes to above 50, you will understand that the market may not be that choppy, but this could be the beginning of a market to start slowing down. So, for example, starting from here, okay, even though the market I mean, of course, like all indicators, there is a little bit of a lag, right? The market started slowing down a little bit, but from here, okay, you are now being given from here all the way to here, okay, all that period of time. That was a period of time where you could have planned on options, non-directional strategies, for example, given the fact that now you have an indication, which is, again, less precise because we dropped the 61.8 line to 50%. So now it's going to be more generous on telling you the market is choppy. Okay. But again, it's a valid observation. Okay. Less extreme, and therefore, from a probability standpoint, um, you may have more stop outs because it's less extreme as a value. But at the same time, I guess that looking for balance, because of course we cannot predict the future, and also indicators, all of them carry a lag. So looking for balance, this could be a valid way, a smart way to identify non-directional trading opportunities. For example, here's another one which could have worked fairly well. Okay, where from here all the way to here, okay, you would have called this market choppy. And again, depending on how large your iron condor was, so this could have been a nice profit. Okay, even though here you can see it's starting to really impulse before we got a crossover, which is the problem of having the upper line pull down. But I guess fair enough. Here's another example of the disadvantage of pushing the upper horizontal line down from 61.8 to 50, which is we have a case of choppiness, but it really lasted for very few candles only, so the duration was less. Okay, so this is the disadvantage. Now from here, again, there's a lot for you to experience with, a lot for you to backtest with before you set your own rules. But just to give you ideas, you can, option number one, bring the line down, which makes it kind of like more generous when it comes to giving you signals, and therefore the reliability is a bit less. But maybe on the other hand, you can move up the length, maybe to 21, and now you have a bit more reliability because you are using more market data, but even though you have a bit less reliability because the upper line is a bit lower. So maybe that could be seen as a valid balance. Okay, and again, this is trader's preference and for you to play with, just giving you ideas on how you could utilize this particular analysis technique. In this case, from here to here, you would have called the market choppy. Okay, so this certainly could have been a place for an iron condor from 130 something to 125. It's a $10 range, something like that. Could certainly work. Premium should be okay. So again, of course, when you do that, okay, I guess it's no need to say, but I'm just gonna say it because I have to. So if you come to that day, which is where the identification of choppiness is happening, of course, for you to do your iron condor, don't do it just because of choppiness. Go ahead and turn on your UFOs, right? And now you have UFOs above, you have UFOs below. So now you can set some sort of a statistical range, right? And deal with your iron condor in this way. So maybe you have the top here, you have a couple of UFOs below, above, and below, something like that. You generate a range. You are selling your units. Assuming it's an iron condor, it could be other strategies, and that's how you would do it. So anyway, this is choppiness. I'm going to move to another tool, but before I do that, I also want to make sure that you guys are with me. So if there is any question related to choppiness, I would love to hear. If there are no questions, I would love to hear that you guys are okay. That all was good. Just type a quick okay. That would help me a lot. I'll take a sip of water and we continue. Very good. So I'm going to start loading the list of studies and getting ready for the next one. Ahmed is okay. It's appreciated, my friend. Very good. I guess some of you are typing. Joe, all good. Very good. This is appreciated. Thank you, guys. So we looked at choppiness. Okay, this is the first tool that I wanted to mention. Another tool that I wanted to mention here that we haven't covered yet is normalized percentages, okay, normalized percentages. So what is that tool for? Well, this tool is a tool where we're gonna do a percentage calculation, and we're gonna compare this tool to another symbol. In this case, by default, well, the symbol that comes by default is SPX, which is the S&P 500 index. Okay, but of course, you can also use it to compare a stock with another stock, oil with natural gas, gold with silver. So again, you could certainly do that. Okay, Mark, does choppiness work with lower time frames? Yes, indeed, it does. Okay, it works with all time frames. Of course, like most technical indicators, typically the larger the time frame, the more relevant, but also the larger the time frame, the least the amount of signals that you will get. And yes, so for sure, that's the same thing like most of the tools that we use in trading, isn't it? So keep that in mind. But indeed, the concept applies. Okay, and while if you apply it intraday, probably you cannot really take great advantage of non-directional trades unless you are doing options on the SPX, for example, or options on the S&P futures, or something like that expire in one day, for example, on the Mondays. So unless you do something like that, it's going to be very difficult, I guess. But for you to take advantage of the effect of squeeze and expansion, so that could be a valid way for you to trade intraday when volatility is about to kick in and you are getting into trades at that time, instead of getting into trades where volatility may be a bit disappointing, which happens often intraday, to be honest. Sometimes you have this very big push at the open, and then the market becomes very quiet for a while until it pushes again. So if the market becomes very quiet, then with choppiness you can measure how quiet it is, and the moment you get that crossover, you now know the market is likely going to increase its volatility, and that's when you come back in. Okay, so just sharing a few ideas for you guys to experience. But yes, indeed, Jeff, you can experiment with it intraday. Yes, Mark, lower time frames is also valid. So normalized percentages. Okay, what this study does is calculate percentages. Okay, so the best way to look at it is just to insert it. So I'm just going to click OK. When I click OK, a couple of lines appear here. One shows 31.05, one shows minus 20.78. So what does that mean? Okay, well, first of all, this calculation goes back to the beginning of the time on the chart, to candle number one. So in other words, this study is sensitive to the amount of data loaded on a chart. So let's say you care about what's happening from a percentage point of view in the last month. So I just went to the format of the chart, right-click Format, and what I would do, this is a daily time frame of IBM, so I would type 21 bars. Why? Because 21 is the amount of trading days you have in a year as an average. Of course, a month like February could be less, but as an average, 21 would do the job. My bad, minimum is 50 here. So if you want to do the monthly performance, you will need to move to intraday timeframes and calculate the adequate number of candles. So let me do this. Let's use it the way you would normally use it, or most traders will use it, which is thinking of yearly performance, isn't it? So 1 year of trading is 252 bars. This is the classical amount of bars in a year. So you would click OK. Now, if I zoom in, so now notice that I got 252 bars. So the date I have on the left is February 16. The day we got on the right, it's February 25. So of course, it's not exactly 1 year if I use 252 bars. But again, depending on holidays, depending on things like that, it would be quite approximate. Okay, quite good as a measurement. So I'll take it as good. And in this sense, we can see that one of the lines is telling you 11.5% in green color. The other line is telling you 3.42% in blue color. So what do they represent? Well, they represent the performance of that stock, which is IBM, compared to the symbol to be compared with, which is the S&P index, which I have it as green color. Okay, so I'm going to make it a bit thicker so we can see the line better, right? So the green color line is the S&P. So since 1 year ago, since February 16 last year, the S&P has been up by 11.5%, while IBM has been up by 3.42%. This is what this study is designed to do. It's basically giving you a percentage and comparing it with a symbol, which could be whichever you choose. So in this case, for example, you can see how the current value for IBM is 124.18. If we subtract this from the closing price of the first candle on the chart, which is 120.07, that means that IBM has, oh, I didn't do the math right. Sorry for that. So 124.18 minus 120.07. Oh, I know what it is. 124.18 minus, yes, now I got it right. So 120.07. Okay. So that stock has moved up by $4.11 out of 120.07, which was the starting price. So that stock is up by 3.42%, which is what you can see here when you look at the value, right? So this is what IBM has done, and therefore I'm not going to do the math for the S&P, but you know the green color is the S&P, so the S&P has been up by 11.5%. Okay, so you could um, you could apply this differently. For example, you may look at Apple on the chart, and you want to compare Apple to a competitor. Maybe you are looking at the cell phone industry, and you are comparing Android versus iPhones. So you may want to add Google as a alternative symbol, and now you can see how Google is a little higher compared to Apple, 26% versus 23%. Okay, so again, this is the application of this particular study. One more time, it's important that you keep in mind that the amount of data loaded on the chart has a direct impact on the measurement. Okay, a direct impact on the measurement. So, which, by the way, this could also be combined, talking about choppiness, with choppiness, right? So let's say, um, let's say you are keen to look for opportunities of contractions, where after a contraction you may have an increase of volatility. Okay? And here we got a case. And you are looking at Apple, and you compare Apple with the S&P. Okay, here we go. And you look at Apple. In this case, it would not be the scenario I was looking for, because in this case, so volatility, sorry guys, here, the crossover. So volatility is now picking up on Apple. So you may want to think of buying Apple. But in this case, the S&P is greater than Apple, meaning that the performance of the S&P is stronger than the performance of Apple, which may not be inviting for a long trade. Now, on the other hand, precisely the fact that the performance of Apple is under the S&P, it's telling you that Apple has been behaving in a way that is quieter than the S&P. The S&P being an index, or any index, you may use the Dow Jones, or any index you use. An index, by definition, is typically a quieter market from a volatility standpoint compared to hot stocks. So if a hot stock like Apple has been quieter than the S&P, right? So that means already you can tell it's been trading in a way that is not that common. It's been quite boring, right? And choppiness is telling you that it's got very, very quiet. So whenever you got the crossover, remember you read this backwards, whenever you got a crossover, and therefore you are supposed now to have or benefit of a potential increase in volatility. So that increase in volatility could be very spectacular, going now with Apple going above the S&P in performance, okay? And, it may have started here. It may have started here with this other case of choppiness, which is similar scenario where the market was quite choppy and Apple was still below. So, this initial case was not a major expansion of price movement. It was, slightly, going higher with a little bit of an angle, but not that impressive. Here was a clear case of expansion of volatility. So that second squeeze worked much better than the first one. But again, here I am combining the normalized percent with the choppiness to kind of also get a measurement of how active or inactive is the stock compared to an index, knowing that hot stocks are often performing stronger than an index because the index is the average of many stocks. In this case, the S&P is 500 stocks. So you often see stocks performing better than the index, but being lesser than the index in this case. It's kind of a double confirmation of choppiness, or maybe another concept to use here. I'm not sure it's a very good one, but it's boringness, if you wish, in the sense that that stock was really doing nothing at all compared to its index, right? So this could be interpreted, depending on the rules of your trading methodology, as an opportunity to watch. And as you get the breakout, as you get the crossover on the choppiness indicator, this is confirming volatility coming in, and this will be the time for you to get into your trades, based on your methods. Cool. That's all when it comes to normalized percentages. Again, you can change the colors, you can change the compare symbol, and that's basically it. Okay. There is also a selection here for use underlying symbol, which this is very useful for when you use options. So, for example, let's say you want to compare a specific call on Apple. So maybe we're looking at January 20, 2023 call on Apple. Maybe we're looking at the 160. So I'm going to copy the symbol. Right click, copy symbol. So I'm copying the symbol of a call. Okay. I'm going to input that symbol on the chart. Okay. I click paste. So what I'm charting now is the call. I'm going to get rid of choppiness because it doesn't make sense now. We're charting a call. So here's the symbol of the call. And instead of comparing the call with the S&P, I want to compare the call with the shares of Apple. Right? So if you do that, okay, and you click OK, so now you have this percentage calculation here, which is Apple compared to the call. Let me see. It didn't work well for whatever reason. This is what I was expecting, okay, to have the green line to be Apple and the blue line to be the call. I'm not sure why using underlying symbol didn't do what it's supposed to do. So I'm going to have to check on my end. But anyway, from a, I guess it's just a minor thing here that we need to turn on. So we'll do that. And it'll be active. But yeah, so in any case, you got the point, right? So you can chart options contracts, okay, and then turn on, use underlying symbol, and compare the options contracts performance versus the stock itself. Yeah. Okay. What else? So remove all studies. How is it going, guys? Give me some feedback when it comes to the normalized percentages analysis tool that we just discussed. Because we got two more to go. One is open interest. Okay, so I'll just wait for your confirmation there. And while I'm waiting for your confirmation, I want you to notice that the platform I've been using for this demonstration is the QC version of Top. So I'm using TradeStation Options Planner for QC. For the next study that I want to discuss, I'm going to bring in Predictive for TradeStation. Okay, so Top for TradeStation. Okay, and the reason why I'm going to make this comment or the switch from Top for QC to Top for TradeStation is because the next study that I'm going to discuss is sensitive to the market data. And obviously, the data sources are different if you use TradeStation or QC, and therefore I need to show you something important. Mark, I understand it. It could be good for comparing a stock to a sector ETF. Yes, very good application, very good application. So you can go ahead and insert normalized percentage, right? And here, for example, Apple is a technology stock, so you can use XLK, which is the ETF for technology. And the moment you do that, here we go. So you can see how Apple is performing better than the technology industry overall. Okay, so definitely another very good application when it comes to understanding the strength of certain stocks in their own industries. Very nice. Perfect. Okay. So next one in the list. Thanks for that, Mark. Next one in the list is open interest. And open interest, I mean, if you trade futures or options, it's for sure you know what is open interest. But for the ones of you that are not trading derivatives, so open interest represents the amount of contracts that are in the market that are alive. Okay. So when a contract is open, it means that it's being traded for the first time. And when a contract is closed, it means that the contract is taken out of the market. Okay, for in the case of options, a clear example of that would be, a buy to open action versus a sell to close action, or more clearly, I guess, you buy a contract and then you exercise your right. So then you have shares, but you don't have the contract anymore because the contract is gone because it's been exercised. So that would either increase or decrease open interest by 1. If you did one contract at a time, or 10 if you did 10 contracts at a time. So that's open interest. And open interest is looked and seen by traders in a way that is or can be seen similar as volume, or simply for liquidity assessment to understand how much a market is being traded. Well, with QC, I'm going to end this very quickly, because if you click open interest and you click OK, so basically the chart below is blank. And the reason why it's blank is because Quote Media, which is one of our market data providers, they don't provide open interest data. And therefore, while we have the tools on the charts in case one day they provide it, the fact is that they don't provide it and therefore cannot be used. Okay, so that one is easy to understand. That's it. Now, if I switch to TradeStation, okay, and I apply it to, let's say, at ES, which is the S&P futures, and I go to add study, same story, and open interest, and I click OK. So notice how now I do have data. And why is that? Because again, many of the things that we do in trading are, data dependent. Well, if the data provider provides the data, then you can do it. If the data provider doesn't, then you cannot. In this case, TradeStation does provide the data for open interest, and therefore you can chart it. Okay. Now, when it comes to settings, you can color the up or down, values. You can also display or remove a moving average, and of course you can change the length. In this case, by default, it comes 20, which is kind of like a month. So you have your kind of like monthly open interest, and then you can see all the bars. This is futures, okay? This is futures, and this is a continuous contract, right? So being a continuous contract, it's putting on the side that is showing those drops, which typically coincide with the rollover periods. You could go back in time, and that chart goes to the infinite as long as you have market data loaded. Okay. Now, when it comes to open interest, I guess this is obvious to say, but if I go back to Apple AAPL and I click enter, so nothing's going to show up. Okay. And the reason why nothing's going to show up is because there is no open interest in the world of stock trading. Open interest applies to derivatives, right? Could be futures contracts or options contracts. Okay. So Apple does not report anything, even with TradeStation, where the data feed is enabled. There is nothing to report because there is no such a thing in stock trading. Same for FOREX, for example. But what about options? Okay, well, if I load an option, for example, I'm just going to pick, any symbol. So I'm going to get that option symbol. Okay, and I'm going to go back to the chart. And what I want to do is I'm going to chart, paste the option symbol, click load. So notice how I do have option interest data for that particular options contract, which is the 175 call that expires on May 20. Okay, that's what I am charting right now, and you can see the open interest for that particular contract. Okay, so again, I guess that I will guess, okay, and again, we are all different in trading, but I will guess that the majority of you probably, when it comes to understanding open interest on a chart, you would very likely prefer to use the volume map, click on it, convert volume to open interest, and get your understanding of strikes, expiration dates, where is the open interest on the call side, on the put side, all of those things. So probably this is a much more advanced, modern, and useful application compared to the classical application of plotting open interest, like if it's volume. But again, some traders do have techniques, especially in future trading, where you could, and by the way, this is going to be now the last study that I haven't discussed, which is volume, okay, which is probably one that doesn't need much discussion because it's very obvious, but since in a way is very related to open interest. So notice how the pop-up box with the options is exactly the same. So if I click OK, notice how now we have open interest on the top, we have volume in the bottom part, and now here you can do certain things. So this is a daily time frame of the S&P. Okay, so I'm just loading more data here. And what I'm going to do is, when it comes to open interest, I'm just going to make the line thicker so we can see that better, first of all. And second, I am going to have a longer period. Okay, so I'm going to use 63, that represents 3 months. Okay, and then I'm going to do the same with volume. Okay, 63, that represents 3 months. I'll make the volume average line thicker. Okay, so what do we have? Okay, well, notice how there are times where we have price, have volume, which is quite intense, defining by intense above the average, which is the 3 months average. Okay, but there are also times where, while volume is very high, you are below the average of open interest. Then there are other times where you are above the average of volume, but you are also above the average of open interest. Okay, and this is, for example, a case where there's huge amount of contracts being traded from a volume point of view per day, but also there is a certain level of creation and destruction of contracts. Okay, so these, depending on the type of trader you are, could give you certain indications. Okay, so for example, so the market is falling very, very hard. Let me zoom in so I can explain this better. And again, this is just to give you ideas for trading plans, for you guys to be able to do your proper backtest, set up rules in case you like this type of approach. Okay, so for example, here we have very strong volume above the average, open interest is red above the average. Okay, we got 4 bars in a row which are red color, all of them above average. We have 5 bars of open interest which are red color above the average, and this is until this day. Thereafter, you got creation of contracts, open interest is green, and the volume is above average and is green. Okay, so this is a very strong sign of bullishness that took place on that next candle, which, by the way, that next candle has the shape of a hammerish doji, if you wish. I just made up a term, right? But my point here is that with that open interest and volume information, you could have concluded that this was to be a very relevant candle, meaning that if intraday you had found, for example, UFOs in this particular candle, trades could have been taken betting on the upside, and a very powerful move from, let's call it 4,300 to, let's call it 4,500 plus. Okay, so this is 200 plus points. A move of that size could have been identified and executed. Okay, so again, this is some of the techniques that some traders use to try to understand when something very relevant is happening in the market, where is that? Okay, now what's the issue with this? I guess you're realizing it from that day, which is January 18, which is when we started going above the average of open interest, versus the last time it happened, that was all the way back in September the year before. So basically, if that's your technique, you got 4 months with no trading. So it's not the most active way on how to trade, isn't it? But at the same time, for longer term investors, or traders that are maybe looking for certain signs to build on certain type of positions, this could be useful, and hence I'm bringing it to your attention for us to discuss today. Okay, cool. So this is again open interest on the upper part, and volume on the bottom part. Okay. Now, one last application I would like to mention, and this has a lot to do with futures trading, and it's not going to be related to options trading. Uh, it's to understand better your rollovers. Okay. For example, with S&P futures. Okay. So if you are typical guy, right, trading futures. Okay. I'm just going to bring a calendar. Okay. So you will look at, again, if you trade S&P futures, you probably know that the expirations are happening on December, then they happen on March and June and September, and back to December, and so on. It's what in futures is called the H, the M, the U, and the Z, right? Or Z in American English. So the expiration date is third Friday of the month, which in December was December 17th. It's a classical rule of thumb to, in the case of the S&P, each market is different. In the case of the S&P futures, it's a classical rule of thumb to think that the Thursday prior to the Friday expiration, which in this case would be Thursday 9, that's when the rollover takes place, and much of the volume and the open interest is moving from what now you will start calling the back month into the front month. So now this is a rule of thumb, but it's not always like that. It often changes and is definitely different per market. And therefore, one way to identify when is the right time or the perfect time to do a rollover is precisely to use a tool of this sort. So if instead of charting at ES, I was to chart the contract specific symbol, ES, and again, we are calling Z, or Z is for December, and we are looking at 21 for 2021. So if I'm looking at ESZ 2021, okay, and this is going to be loading. So we can certainly see that starting on December 9, okay, December 9, okay, so right here, so we can see how there is a drop, okay, there is a drop on the open interest, but the volume actually is greater than the day before, okay, so may or may not be the ideal day to do a rollover, right? Now, I'm going to bring in another chart. With this other chart, I'm going to look at ESH 2022, which is the contract that would expire in March 2022. And I'm going to add same story, open interest and volume. Okay. And I want to float this. I'm going to put this on the right. I'm going to put this on the left. Okay. Here we go. So on the left, I got December 21st expiration for the S&P futures. On the right, I got March 2022 expiration for the futures. And what I'm looking for is December 9 on the right as well, okay, which is my red vertical line. Okay, so notice that let me get chart values here. Here we go. So notice that the open interest on 09 2021, okay, is 2035,000, okay, so 2000K, okay, and the volume is 1.5K, okay, where here on the right, the open interest is 535K and 597K on the same day. So guess what? Even though many people are doing the rollover on that day, the rollover has not really concluded on that day. So what about the next day? Okay, well, on the next day, we are dealing, that would be December 10, we are dealing with 1600 and 1500. Okay, so let's take a look. On the right, on the next day, we are dealing with 1000 and 1600. So volume is coming in now. Okay, so the second day, which is the Friday before the expiration, not the Thursday, the Friday before the expiration, volume is coming in, but open interest is not really there yet. Right? So what about the next day? That's going to be Monday 13, right? So on Monday 13, let me move the line to the right place in both cases. So on Monday 13, we are talking about 1000 and 1600. Okay, where on the right, we got more open interest and more volume both. So to me, December 13 would be the perfect day to do a rollover, not before. Okay, most people will start rolling over on that Thursday prior to the Friday expiration, and then people will wonder, why is it that I got some slippage when I got stopped out? Again, there was not that much volume and open interest compared to the prior contract until the Monday after in this particular case. So this could change, right? But again, this is a great tool for you to be able to monitor and know more precisely when the rollover needs to take place. Cool. Okay, so you guys, please let me know. Two questions. So first of all, how is it going? Any question about open interest and volume, which were the last two items from the ad study menu that we have with so many possibilities and tools? Let me know if there is any question related to any of these, what we covered today, or any other of the studies. This is the material I was planning to cover today. So basically, when it comes to the session today, I'm basically done. So obviously, if you have any question additional to today's lecture or any other question of any other sort, feel free to mention it now on the chat box so we can talk about it. We got 10 minutes. So certainly happy to discuss anything you guys may need. Let me know. And as always, I'll take a sip of water while I'm waiting for your text. If all is good, please let me know all is good. And then we'll just call it a day. And again, it's very appreciated when you guys give me feedback, even if it's just a simple okay. It means a lot on my end because I don't know what I don't know when it comes to how did it go for you. Let me know, please. Thank you, Jose. Thank you, Ahmed. So no OTA, yeah, 107xn is absolutely not the best setting. Based on what we did today, you could use 105xn. Okay, ES equal 105xn would be much more adequate. Future sessions, how to use the rewind with options replay. Very good. Very good. To be honest, we can talk about this now because we already talked about options replay, and I'm positive, Joe, that you are well into it. So how to use it with a rewind function? Okay, maybe it's something that we can address now quickly, and that way you get your answer. So that way, next time we can just focus on the matrix. Obviously, any other question you bring to me, I'll be happy to discuss. Okay, but just to have like a main kind of subject. So next time we'll start with the matrix. So here's Apple, okay? And let's say you want to work on the options replay, and you come here to options replay, and you add this tool. Okay, and I'm just gonna add with anything, whatever it is. So the moment you put it there, automatically this tool is being plotted, a few days before today in that particular location, and it comes as a default with a long triangle, and here's your PNL and whatever. So obviously, when you work on backtesting your option strategies, you're gonna have to work on three aspects. So aspect number one, going back to your chart to a point in the chart where whatever you look for when you trade is found. So for example, let's pretend that your trading methodology, for example, let's say you do non-directional trading, and your trading methodology tells you that, okay, that day is when you have a triggering condition that tells you, okay, time to enter, let's say, an iron condor. So first thing, you will want to rewind using the rewind button here or here. You will want to rewind to the day on the chart where your trade is. And as you do that, you should also rewind the slider with the options replay to that particular location on the chart. You may argue, look, you could move the slider without moving the chart, and it will look like that. The chart, so the slider is in exactly the same place, even though you have the whole visibility of the chart. For sure, you can do that. But when it comes to backtesting, to avoid any temptation of cheating, uh, not that is your intention, but sometimes it may happen subconsciously, right? So that cheating intention may happen without you noticing because we are human. So to avoid any of those temptations, strongly recommended to click the rewind button, the training mode, go back in time, and then move the slider to the specific location that you want to discuss. From there, you will then right click, and this is item number 3, right? So item number 1, rewind. Item number 2, slide, the slider. Item number 3, now set up your trade, right? And let's say your trade is an iron condor, so you can come in here and find short iron condor. You can also go the route, if you want to do it like very basic, you can go the route of delete everything and just add 4 legs, right? And you got the calls above, you buy one, you sell one, and you got the puts below, you sell one, you buy one, put, and then you may have a specific set of rules on how you select expiration date. Maybe your expiration date was November 5, so you change November 5, everything changes. Okay, I'm not sure if you have noticed, but if I change the date anywhere but not the first row, it will only change it there. But if I change the date on the first row, okay, it will change everything. So that saves you a bit of time as well. So let's say you are doing November 5, I'm just picking a random number, and then now you would look at the current price. That day was 149. So again, turn on the UFOs, use Bollinger Bands, whatever your methodology is. Let's say your methodology had you use, let's say for example, I'm just gonna do 155 and 152 and a half. Okay, and on the bottom part, so maybe that's 150. So we'll do 157 and a half, 155. Okay, just to make it equal. Again, this would be your methodology. Okay, you apply your methodology, then you click OK. And the moment you click OK, you're gonna get to see the P&L here. Okay, so this trade actually made $45 per contract. Congratulations. Okay, but again, the simulation is showing you all the way to the expiration date, which may not be your exit point. Your exit point may be different depending on what is it that you do. So my recommendation would be that you try to put yourself in the shoes of you doing the trade in the past, and therefore you click one candle at a time, and you go back to review your P&L. When you put the mouse in here, okay, you can see the P&L here, right? So you may make a note, you may apply your management rules, whatever that is, and you keep going, right? Let's say instead of looking at the P&L, you are interested in looking at the value of the spread, right? Or maybe, for example, in this case, we are doing an iron condor, but you want to treat the iron condor separately, the put side and the call side, right? So maybe we're gonna do. Wait a minute, I did this backwards, isn't it? 147 and a half. Yes. Okay, I'll do 148, 146. Sorry for that, I did it backwards. Okay, here we go. So now you can go ahead and insert a second options replay. Okay, and do the same thing. So here's the options replay. So we got the bull put, right click, and now we're gonna be doing the bear call. Okay, using November 5, and that we said 155 and 152 and a half. Hopefully now I'm not making a mistake with the strikes. And you click OK, right? And now, so the net result of the trade will be the result from the one below and the one above. Okay, and notice the one above is not using the right expiration date. Number 5. Yes. Okay, now I got it right. Sorry. So here we go. So now I have it right. You have the bull put spread and the bear call spread. So now you have all your settings here. And as the trade is progressing, okay, so you could try to understand how it happens. So let's say, for example, you have a rule where if any of those spreads were to be closed at a certain value, so you can right click and go to the properties, change instead of dollar change to dollar value. Okay, and now what you get here, okay, is the value of the spread. Right? So for example, there was a moment in time where the spread was worth 15 cents. Sorry, 14. Okay? There is a moment in time where the spread is worth 44. Okay? So that's the spread value. Okay. So again, you may have rules when it comes to some of the units or some of the spreads within your trade that get you to here we go, get you to close the trade or not to close the trade or whatever. So you can break it down into multiple pieces. In this case, I broke another corner into 2 pieces, so you can evaluate better your management rules. I'll add one more, okay, which typically does not apply to a non-directional trade. But let's say, for example, as the stock now is going like crazy, you have a rule that says, look, now I'm going to buy long shares. Okay, so you can add one more options replay, and even though it's called options replay, you click OK, and you move it to that date. Here we go. So you can now, on this other date, right-click, remove the options, okay, and add a stock leg, and be like, okay, I'm buying 20 shares, okay, and I got filled at whatever price, okay, and you click OK, and now this will also emulate. Sorry, fill price. So that was, I don't know, let's say I got filled at 151. So the moment you do this, as the stock is moving, so you can see how the P&L is being impacted, okay? And I went all the way to the end of the chart, but again, on that expiration date or whenever it is that you would close the trade, your net result would be the result of those 3 particular values. Okay? Where one is negative and the other 2 are positive, so whatever. So anyway, so this is basically how you do it. So basically, long story short, is kind of like 3 type of actions, right? So go back in time first, we use the training mode, the rewind button. Number 2, slide the slider to the right location. And number 3, set up your options trade in a way that then you can evaluate during the life of the trade. As you click play, you can evaluate what to do in the life of the trade, assuming that you have trade management rules, which I'm sure you do, and you can really backtest the whole thing properly. Okay, so that is how I would recommend you to do it. I guess it's quite straight to the point, quite practical, and you emulate as much as possible the real-time conditions if you had been trading at that time in the past. Question, Joe. Is there anything else you would like me to discuss concerning this, or was this the type of answer that you were looking for given your question? And everyone else, any other question? Because if that's not the case, then we will call it a day. But I would really like to hear from all of you so I get confirmation that everybody's with me, and especially you, Joe, when it comes to your question. Thank you very much. Thank you very, very much. Very good. So we made it and top of the hour, end of the session. Thank you so much for joining me. Like almost always, not always, but almost always, I owe a couple of emails here and there. So bear with me, guys. I will be getting back to those emails fairly quickly. And also, thank you very much. Some of you have been sending emails with suggestions of features for the platform and things like that. Really appreciate your detail-oriented approach to using the platform. It's really, really helpful, to hear your feedback. So thank you so much. Keep doing that, and thank you for being part of what we do, guys. It means a lot. See you soon, my friends. See you during the weekdays in the trading sessions. See you then. Bye bye, everybody. Take care.